It's the time for another wonderful presentation by Mr. Ankit Agarwal. He's an equity fund manager at UTI Mutual Fund. So, Mr. Ankit has chosen the topic today: nuisance of small cap investing. This is again something which advisors would love to hear on, sir. And because we have been discussing about investments, global investments, estate planning, retirement planning, life insurance, and now small cap investing. Over to you, sir.
Yeah, thanks a lot, Dimple, for that. So I'll just cover a few, in my presentation, I'll cover a few reasons why you should have small caps in your portfolio. Why, how does it make sense? What are the risks of investing in small caps? How can you mitigate some of these risks? And then that's where a trusted advisor comes into play. And today, is it still makes sense to invest in small caps? And I'm sure with markets at a high, this will be one question that a lot of your advisors would be sort of grappling with. So let me just quickly jump into why does it make sense to have invest in a small cap in any case. So if you look at the large caps, right, in any asset allocation, it makes sense to have certain allocation among small caps simply because it gives you an ability to diversify away from some large cap heavy sectors. So if you look at the large cap index, it's heavily skewed towards financial services, oil and gas, IT. So these three sectors from a large chunk of uh, the uh, the portfolio of a Nifty 100. But if you look at the small cap index, it's fairly well distributed across different sectors. And not only that, some of the emerging sectors that we are seeing currently, whether it will be maybe chemicals, services, healthcare, a lot of these sectors find representation only in the small cap space. Therefore, not only from a diversification perspective, from an asset allocation perspective, if you want to benefit from some of these growth opportunities, some allocation to small cap definitely makes a lot of sense. And not only that, if you want to capture a niche, for example, if you are very bullish on the dairy sector and you want to play that through large caps, you would be stuck with companies like Britannia, Nestle, who have dairy, but very small part of their revenue pool will be coming from there. So for Britannia, that number is less than 3%. But I could play the dairy opportunity through some of the other companies which are present purely in the small cap space. So for example, Heritage has almost 96% of their business coming from there. So that gives you the full entire benefit of that niche opportunity, which you can target through a small cap opportunity. So this also makes it very important to have certain allocation to a small cap business. Historically, and this is, you can look at a lot of the companies which are today large mid caps, or in fact large caps. At some point in time, these were small caps in the past. And as long as your stock selection is right, the possibility or the potential to capture some of these businesses only resides in small caps. So therefore, the upside potential of investing in small caps is pretty high. And that is obviously also comes from the fact that a lot of these opportunities which are present in small caps are fairly under researched and under owned. So you don't find enough sell side coverage. Most of them concentrate more on large caps and maybe large mid caps. Therefore, this segment gives you an opportunity to find some of these companies which may be ignored by the broader market, but they could offer a lot of potential, and they may be fairly undervalued for the quality of business that they might be. And therefore, having a in-house research team which covers some of these opportunities also helps you identifying some of the great opportunities which might be present in the small cap space. So this is the reason why you should look at some of these small cap companies, because not only do they offer diversification in when you're looking at it from a broader asset allocation perspective, but they also offer you a lot of upside opportunities as long as your research is in place. So, having talked about some of the opportunities which we see in the small cap sector, let me also highlight some of the risks which are present over there. So clearly, volatility is a very high in this segment, and anyone who invests here has to brace for higher volatility, at least in the near term. In the longer term, probably you might get your desired IRRs, but at least in the short term, you have to brace yourself for higher volatility. This segment has problems of liquidity. So liquidity is a concern, and impact cost of getting in and getting out of stocks is also on the higher side. And lastly, because these companies are fairly early in their growth cycle, business and promoter risks are on the high. So they do get impacted more by business cycle volatility. They do have a higher cost of capital. They have problems in attracting quality managerial talent or professionals. They do suffer from more product concentration risk, geographic concentration risk. And that's why some of these businesses may have a little bit higher volatility as compared to some of the larger caps. But there are clearly ways by which you can mitigate some of these risks. And in the next part of the presentation, I'll highlight some of the ways by which we mitigate these risks in our portfolio. So the first and foremost, anyone who wants to do small cap investing has to have a fairly large team to back him. So like I said in the early part of the presentation, you have to have a, a very strong research base, because there are a lot of opportunities here are not covered by the broader market, or maybe under researched and under owned. And therefore having a very large team who covers different sectors gives you that strength to research these companies, do detailed due diligence, understand what's happening on the business, the promoter, what the promoter is thinking. And therefore that becomes a big cornerstone of how you can invest in a small cap entity. That combined with a very strong investment process. So our we focus as a house, we focus a lot on return on capital employed and operating cash flow, which form two big pillars of our investment process. And that filtering, once you do it on the entire universe, you can, and after studying some of the qualitative factors like management quality, how the business is scalable or not, what's the vision, long-term vision of the promoters, then you can narrow them down into 60-70 stocks, and that forms the part of your small cap portfolio. So again, having a strong team, having a very strong research process, when you not only look at quantitative factors, but you also look at a lot of qualitative factors to understand how these small caps can eventually caps of tomorrow, or maybe large caps after that. And then portfolio construction is the third leg by which you can reduce the risks of investing in small caps. So maintaining a diversified portfolio is important, because you don't want to be overexposed to a given stock, even though you may like that opportunity, because if your investment hypothesis, maybe if it goes wrong, you should not incur significant impact cost in your portfolio. Another way of reducing the risks in the portfolio would be position sizing. So you want, based on your relative conviction in an idea and what is the market liquidity available with respect to that, you can size that position appropriately in your portfolio, and that will give you an ability to manage the risk, overall risk. So so therefore using these ways by which you can have good research complemented by your portfolio construction strategy, you can reduce the risk available in the small cap universe. And then quoting Warren Buffett here, risk comes from the fact, from what you don't know about the business, right? So if you try to do your due diligence well, and if you have chosen the right companies, sooner or later you may your returns may get delayed a bit, but you will make your desired IRR over a period of time. And this slide actually encapsulates this importance of stock picking, where you can see that the potential to create multi-baggers is very high in the small cap segment. Although the risks of putting choosing some of the poor quality stocks are also high. And therefore your team's experience, your research framework again, and your stock picking ability could differentiate between what an average small cap index would give you versus what an actively managed strategy can possibly give you. And therefore actively managed small cap portfolio makes a lot more sense, because you need to choose your opportunities right. The universe of small cap opportunities is very high. The number of small cap stocks which you can possibly invest is very large. And within that large pool of opportunities available, you need to make the right selection. And as long as you make that right selection and you hit a lot more companies in the green patch and avoid companies in the orange and red patch, you would make decently high returns in the long term. I think the focus has to be on that. You do have a certain amount of risk in the small cap segment. There are risks inherent in that, but you can mitigate a lot of these risks if your stock selection is right. So we saw that, why investing in small caps is right, how it makes sense from an asset allocation perspective, what are the risks of investing in small caps, how we saw we can mitigate some of those risks. Let's look at why small caps make sense, or a small cap fund makes sense even today. Now, so for that, we'll just have to go and give a little of historical context, where in the past we have seen across multiple cycles, the small caps, if you look at the 2010, 11 sort of to 2013 period, small caps had significantly underperformed. And if you were sitting in 2013, you would have the same thinking, is it the right time to invest? Long term, we have not made that much money. So whether to invest in small caps or not. But 2013 to 17 was a great period for small caps, and the proportion of small caps within the Nifty 500 index increased from almost 4% to 8%. And the large cap proportion came down. But then 2017, there were a lot of disruptions in the market. You saw periods of demonetization, you saw GST, you saw NBFC crisis, and then again the small caps proportion came down and the large caps went up. Now going ahead, now what do we believe? Our sense is that if the interest rates remain where they are, and the liquidity that you are seeing being available to the small and the medium enterprises, if that continues, then possibly the small caps, and if you see a broader economic recovery, the small cap proportion can actually go up. That, coupled with new emerging business models which are coming in the form of new IPOs, you could see this proportion actually go meet 8% and maybe even go higher. So our sense is that going ahead, it is still not a bad time to invest in a small cap opportunity. If I look at it from a price to book perspective, and the reason to choose price to book over price to earnings is that earnings are seeing significant disruption in the near term, and the PEs will look all over the place. So therefore, a more stable metric like price to book makes a lot more sense. So if you look at the price to book metric, we are closer to fair valuation if I look at it from a long-term basis. And the same thing on a dividend yield perspective is actually on a fairly favorable level. So from a dividend yield, so if I combine these two operating or valuation metrics, we are somewhere in between fair to attractive valuation, and nowhere close to the highs that we saw in the 2016-17 period. So that is something to actually keep in mind. And when I look at the 3-year rolling returns, in fact, we are actually very close to the lows that we saw in 2013-2010 period, where the 3-year rolling returns for the small cap index was quite dismal. But then we saw that huge rally which happened during that period, which pushed the 3-year rolling returns to almost 38%. And therefore, our sense is that even post this rally, we have barely scratched the surface as far as the returns are concerned, because we are still closer to the bottoms that we saw in the past. And same holds for a 5-year return basis, where we are still very much close to the bottoms that we saw in the past. So don't get too carried away by the recent rally that we have seen in the small caps vis-a-vis large caps, because if the broader economy is to recover from here and interest rates remain low, the marginal benefit to a small cap company would be on the higher side. And the trends that we are watching today, where the unorganized is giving share away to the organized sector, where you are seeing significant cost cutting from an operating cost perspective that a lot of the companies have undertaken in this pandemic, that coupled with lower interest rates, going ahead, even if the revenues came back to the levels we saw last year, we would see a significant operating leverage benefit and financial leverage benefit on the bottom line. So the growth on the bottom line can in fact be much higher as compared to the growth in top line. And that basically, if earnings expansion happens going ahead, that will drive the next rally in the broader market. And that's where having certain allocation in the small cap fund is very important. So that's where we have launched this NFO on the UTI small cap fund. NFO has opened on the 2nd of December, and what we are trying to do in this opportunity is try to identify companies which have a long runway of growth, and therefore will give you that benefit of compounding. Because at the end of the day, if you look at the basics of investing in small caps, mid caps, is that you want to capture companies which are in fairly early stage of their growth cycle, and as these companies compound their earnings, you believe that your investment in them will also see that compounding effect. So you want to choose such businesses which will give you that compounding benefit in your portfolio. And that same strategy we have employed in the mid cap fund, where you have seen a very fairly good performance across a very wide variety of periods. And hopefully, if you apply the same strategy on the small cap universe also, you would see that benefit. We also complement the strategy by having certain amount in turnaround and transformation, again, which are good businesses, but maybe going through a potential uh, uh, a temporary phase of downturn, and therefore a potential mean reversion playing out. We have a fairly diversified approach because, like I said earlier, in the small cap universe, you need to have a little bit of diversification to be able to manage stock specific and liquidity related risks. And we are a true to label fund, so we want to give investors a complete benefit of investing in the small cap universe. So I'll just run, so I'll not cover these ideas. So who should invest? And just to sort of summarize this, who should invest in the UTI small cap fund? So anyone who's sort of looking at slightly higher return in their portfolio relative to their other diversified funds can look at certain allocation to this opportunity, although they should be able to ride that underlying volatility and have a slightly higher time horizon. So as long as your stock selection is good, our belief is that this has to be part of everyone's asset allocation, because if you want to get that slightly high yield kicker in your portfolio, you need to be in this small cap fund. I think that's where I'll just summarize this discussion and say that small caps is a great place to be as long as your stock selection is there, and you need a good trusted advisor like like us to able to make those decisions for you and do the due diligence and do the filtering for you, so that you don't have to do these on your own. And reducing the risks in that portfolio will help you see the growth that we can see in the small cap universe and potentially benefit from that.
Thank you so much, Ankit sir. Thank you so much for demystifying small cap investing in stocks for us. I think it's always small cap investing is something which advisors really want to know, because there's always a lot of questions regarding the same. So thank you so much for sharing your valuable insights with our attendees and demystifying this mystery for us. Thank you so much. It's a
Thank
pleasure to have you here with us on this platform.